Welcome to Chit Chat Stocks. Before we get to this episode, we want to talk about our friends at Public. If you trade options, you've got to ask yourself, why wouldn't you choose an options trading platform that puts investors first? At public.com, there are no commissions or per contract fees. And more importantly, it's the only platform where you can earn a rebate on every single contract traded. That means you can save on your options trading costs and keep more of your capital in play. Whenever you trade options on Public, your savings are automatically applied. So don't change your strategy, change your platform, and see the difference in your bottom line. No commissions, no per contract fees, and it's the only options trading platform where you can earn a rebate on every contract traded. That's public.com. This is paid for by Public Investing. Options are not suitable for all investors, carry significant risk. Full disclosures are in the podcast description.
Welcome to Chit Chat Stocks. On this show, hosts Ryan Henderson and Brett Schaefer analyze businesses and riff on the world of investing. As a quick reminder, Chit Chat Stocks is a CCM Media Group podcast. Anything discussed on Chit Chat Stocks by Ryan, Brett, or any other podcast guest is not formal advice or recommendation. Now please enjoy this episode.
Welcome to Chit Chat Stocks. I am one of your hosts, Ryan Henderson, and I am joined as always by our other host here, Brett Schaefer. Today we have one of our deep dive episodes. We try to do these at least once a month where Brett or I digs deep into a stock that we are either interested in investing in, maybe already own, or just one that piques our curiosity. And today we are talking about one of the leading beer brands or beer companies in the world, and sort of an umbrella of different beer brands as well. It's Molson Coors. A lot of people will probably recognize the brands as we get into them, but I guess, Brett, what inspired you to look at Molson Coors?
Yeah, so I'll say thank you everyone for listening once again. Hopefully you enjoy these episodes. One housekeeping item, there's going to be a lot of charts on these type of episodes, so this is the perfect time to subscribe to the free newsletter to get all that info along with this episode, which we'll be publishing the day this releases. But yeah, let's get into it. Molson Coors. What inspired me to look at this is simply seeing, checking out on our friends at FinChat that the EV to EBIT, EV to gross profit, price to earnings was at one of its lowest levels, and perhaps even the lowest level in the last 10 years. And I was like, all right, let's dig into it. It was at a single digit EV to EBIT. And I thought, hey, this might be interesting considering the brands have been pretty durable within their category over the last 40, 50 years. But yeah, they do own, we'll get into more details here, Coors Light, Miller Lite, Molson for the Canadian listeners out there, UK brand Carling, and then some Southeastern European brands as well. But my question for you here, Ryan, as we did some good timing on this episode, actually, I didn't even think about it, but it's going to be coming out the day before the 4th of July, one of the biggest beer drinking holidays in the United States. When I say the word Coors Light, what comes to mind for you?
Cold beer.
Exactly. That's the
cold beer.
It's funny. It's a simple advertising tag. They've done it for 40 years, but it's when someone says Coors Light, I just think of the cold cans, the little Blue Mountains thing, and then their marketing tagline that they continue to do, which is just our beer is cold and it's from the Rocky Mountains, and it seems to have worked.
Yeah. I mean, they really have done a good job. Like in my head, I think, oh, I like the taste, but maybe I have been just swayed by the snowy commercials that they've done over the decades.
Yeah, and we will talk about whether, and it's a lot different than the soft drink category, whether this has been a similar strong marketing campaign over decades, similar to a Coca-Cola and a Pepsi, where they talk about happiness and stuff like that. But we'll get into what they own. Like Ryan mentioned, they're one of the world's beer conglomerates. It's the second largest brewer in the United States, where 75% of sales in the country come from 3 companies. There's AB InBev, Molson Coors, which we're talking about today, and then Constellation Brands. But importantly for Molson Coors, 80% of its sales come from the Americas, and the Americas just means North and South America. But within the Americas, 84% of those sales are from the United States. So, just doing some back of the napkin math there, This is a US driven business. This drives the boat. It's where all the earnings power comes from. It's where all the sales power comes from. And yeah, some growth may come from the European market, the Latin American market over the next decade. But if you're looking over the next few years, the US market is what matters. And it's what we're going to focus on a lot today, because there are some concerns that people have. And that's why the stock is trading at such a low multiple.
Yeah, let's get into the business here a little bit. What does Molson Coors actually own? And then what ultimately drives sales for this business?
Yeah, so Coors Light, Miller Lite are 2/3 of their sales. So they own the Coors brand and the Miller brand. Yeah, there's some subset of those categories, but the biggest ones in that are Coors Light and Miller Lite. You have Miller High Life, you have Coors Banquet, but those are much smaller. And then the rest coming from this other 1/3 are going to be the other beer category. They have some cheaper ones like Ice House, right? That's a I'd call, what do they call it? A value, maybe. I don't want to call it a subscale or like super cheap, but a cheaper beer. And then they have some niche brands like Hop Valley. Then a ton of other stuff. There's also Blue Moon, which is a small part of the business, but is considered one of the largest craft beer brands in the United States. And then if we look outside the US, 20% of sales come from Europe and Asia, mainly focused on the United Kingdom and Southeastern Europe. They own brands such as Carling, which is huge in the United Kingdom. And I will mention again that Europe could be a small growth driver if they keep executing in these markets, but the United States is what matters. And then as a note, before we get into the history here, in 2016, Molson Coors fully acquired Miller, which cost about $12 billion. It was a debt-fueled deal, and we'll talk about the details of that later and how they've absorbed that, how it may have been a bad timing to get that full acquisition there, as it was right when seltzers were about to take over the market, and how it impacted their balance sheet and how they've recovered today.
All right, before we go any further, Brett, what is your favorite beer?
I like the Mexican beers myself. Pacifico,
Okay.
Dos Equis, Corona.
The market share gainers over the last 2 years?
Yeah, Modelo as well. Modelo is now number one in the United States, according to this chart we'll have in the newsletter. But if I'm going for a light beer, I do think Coors Light is the best for me personally. I think a lot of people on the West Coast would say the same if we're going for those standard light beers. But I know, and this is what makes the beer industry tough, and probably tougher than a lot of other markets, is it really comes down to personal preference. There's a lot of brands out there, and yeah, Coors Light has grown, but it's also, there has been some periods where it's struggled, and we'll get into that.
It's very regional. I think that's something that a lot of people probably don't appreciate. Is we were talking about this before we hit record. Coors Light's very popular out here in the Pacific Northwest, but it's not the top brand in the Southeast, the South, the Midwest. There are regional beers that maybe because it's from that area and it's just kind of been a cultural thing for a while, that's where it's the most popular. But we've kind of alluded to it a little bit. Let's talk about the history. How did Coors get started? And maybe give some context around some of the big product launches or big drink launches.
Yeah, so this is an old company. For anyone that's a Lindy type investor, this could be one that maybe piques your interest. But according to the company website, this is how the Coors Brewery began. Quote, Adolf Coors, a penniless brewer's apprentice, stowed away on a ship from Germany in 1868 and made his way west, coming upon the perfect water of Clear Creek in Golden, Colorado, at the foot of the Rocky Mountains. He opened a brewery in 1873, and a century later, in 1978, Coors Light was born. It is now one of the best-selling beers in the U.S. and enjoyed by beer drinkers in more than 25 countries worldwide. Well, I'm not sure how... it's a good story for the heritage to say that he was like an explorer out west. He found this creek, he established this settlement, and then he built a brewery, but I don't know how TBD if that's actually true. Now, the original Coors is that gold can that people might be aware of. They call it the banquet beer. It's a focus, more of a niche brand with a focus on, say, cowboy culture, ranching culture. For example, today the brand is working with the Yellowstone TV show. For advertising, you see tons of ads for traditional Coors at, say, a rodeo, for example. Now, that brand is growing, but it's not as important. But Coors Light is the important one that has been the growth driver over the last few decades, and it can really be traced back to World War II. from the company website, they have some quotes here about how in World War II, and this is right after the prohibition was lifted in the United States. So that was when the breweries had obviously a tough time because they couldn't legally sell beer. They had to switch to non-alcoholic beverages. They tried to make a lower ABV beer. Coors Light was born. And then during World War II, they said they claimed it as an ad that it was the greatest achievement in all of brewing history. They had the same Rocky Mountain tagline and stuff like that. But during that time, it came and went quickly because the war impacted the beer. They were forced to make beer for the troops. So it says here that materials were in shorter supply and breweries were required to send 15% of their output overseas to boost the morale of troops, which is, I think, was an interesting anecdote. I didn't know that was the case, similar to Coca-Cola, I guess. Then in 1978, management was looking to expand beyond its single Coors product, which I think 100 years in, they only had one product, which is a good testament to that founding management team. Now, today they have so many other products, and it's a totally different story, but I think that was quite interesting. Yeah, go ahead, Ryan.
Yeah, it is funny. You think about during wartime, you usually think about industry being people taking industry resources and allocating them to wartime activities. Beer brewing is probably not the first thing that comes to mind. And so it's kind of funny. You almost don't even realize that lots of industries throughout the country were probably allocating resources to it beyond just the military support ones.
Yeah, and I don't know if aluminum cans were popular for beer back then, but I'm assuming the resources were shifted because, aluminum was in short supply and probably for those military things. But yeah, they were, a single product brand until the 70s. And then in 1978, they came across this old, the management team was looking at some of their old stuff and they said, hey, we had this Coors Light idea back in World War II, but we had to shut it down because of the story I mentioned before. They launched it with the same brand saying, Rocky Mountain cold refreshment with with a lower ABV. A lighter beer as they were getting popular at the time, and since then it's become a hit and grown into the third largest beer brand behind Modelo and Bud Light in the United States today. Market share is estimated to be between 6% and 7%. Coors Light, again, since then has remained consistent with its advertising since launch, trying to be itself, tie itself to the Colorado Rocky Mountain heritage. They say stuff like, as anyone who's watched a sports game and seen an advertisement has noticed, beer as cold as the Rockies, cold activated and cold brewed. Choose chill is their new one. It's all focused on the cold beer, and they have that visual imagery around that. It's a weird tagline because essentially they control how it's cold during the process, but it's really up to the consumer whether it's in their fridge or in their cooler or not. But the question I have is, Ryan, does this heritage and advertising connection give Coors Light a competitive advantage versus any other beer brand out there?
I wouldn't say it's a huge competitive advantage, but it is an advantage. There's mind share here. It's hard to replicate the years of friends and family choosing that brand when if you're just looking at the beer aisle and you're looking across tons of different selection, you'll go with the one that there's experience, there's heritage, it's still not super costly relative to other brands, and I think a lot of that is hard to replicate for a startup.
Yeah, I think it would be as well, especially for the light beer category. Now, this is not where they're running into any trouble. I mean, you could probably see that within the light beer category, they've maintained market share or even grown. And it's really hard for someone to come into this because you have Coors Light, Miller Light, Bud Light, and maybe the Mexican ones, Corona Light and stuff like that. I forget what they call it. But yeah, let's maybe talk about this throughout the episode because that is a big question. It's definitely not as strong as a Coca-Cola where, at the end of the day, the tastes are probably very similar. But Coca-Cola and Pepsi and stuff like that have been able to maintain that oligopoly position with some of the other players. Now we'll talk about Miller. Miller's another one, important one as well. Keep it shorter for here. Miller was, the name of the person. He was another German immigrant who started a brewery in the 1800s. Miller Lite was launched in 1975, and I think was the first light beer. And has kept a similar tagline of great taste, less filling ever since. You probably, remember that one, Ryan, as well. these companies throw out a lot of commercials similar to the soft drink companies and other brands.
Yeah, if you watch American football, it's hard to not know a lot of these taglines because
Exactly.
they seem to dominate the commercials. But let's move on a little bit to the industry dynamics. So I think a lot of people understand that there are some leading brands in the beer space, and there's some advantage to being a leading brand in that space. But let's go through the industry dynamics. What is happening right now? What is happening to alcohol overall? If you look at the multiples across the board, there are a lot of alcohol companies trading at dirt cheap multiples relative to their history. So record low multiples. Why is it? What are the concerns?
Okay, I think there are 4 things to understand over the last, say, 2 decades that have impacted the alcohol industry and impacted this company in particular. First, spirits. So again, that's alcohol, whiskey, rum, tequila, stuff like that. That is gaining share versus beer and has steadily been gaining share for a few decades. Here's some quotes from early 2023. I won't read them all here. I'll leave some of those for the newsletter. Quote, in 2022, spirits gained market share for the 13th straight year in the fiercely competitive U.S. beverage alcohol market as its supplies sales reached 42.1%. After years of steady growth, it marked the first time that spirit supplier revenues have surpassed beer, but just barely. The Spirit Industry Group said beer holds a 41.9% market share. Now, that's not something you want to hear from doing research when you see the fiercely competitive U.S. beverage alcohol market, although that might be a bit of a, there's only a few companies at the end of the day that own a lot of these things. Now, the second thing is the growth of hard seltzers, which has been specifically important for beer. Now, hard seltzers essentially went from zero to $17.5 billion in worldwide sales over the last decade. This has, obviously been a headwind to the traditional carbonated alcohol beverages such as beer. However, at least for now, seltzer volumes have peaked, and perhaps that has helped Coors Light and Miller Lite as they've grown, have had some few. I think the last 6 quarters or so have been quite good for them. Third thing, in early 2023, Bud Light had an advertising incident that a lot of people, I think, are aware of. And if you don't remember, it's probably because you don't follow the news, and it's fine. All you need to know as an investor is they had an incident. A lot of people are upset that drank Bud Light, and a good chunk of them stopped drinking the product. Drinkers switched to Mexican beers, Miller Lite, and Coors Light, which I will show a chart here that I think is interesting for all our video listeners. Let me share it quick. Essentially shows that if you looked at Bud Light right before the advertising incident, its market share had gone down a little bit, but it had been pretty steady. But there was a steep. Oh wait, whoops. We'll do that one. There was a steep drop off after this, and the gainers, which you can see here, Bud Light went from about 10% down to almost 7% within a few months, and the gainers were Modelo, Coors Light, and Miller Lite, and they've seemed to kept this share ever since. Any thoughts on that, Ryan?
Yeah, it's a little hard to parse through and get a sense of like what direction it's heading, just because it seems like there was a lot of competition from seltzer over the last 5 years, especially 10 years, I guess you could say, that's slowly eaten away at the margins of the average beer drinker. More and more people trying seltzers, although that growth has certainly faded, and it's actually had a lot of headwinds over the last couple of years. If you pay attention to, I think, is it Boston Beer that owns Truly, and someone else owns, can't remember who owns White Claw.
Yeah. I at least Boston Beer owns one of them. Yeah, but for Molson Coors specifically, investors should know, or any listeners should know, that they don't have a big exposure to one of the top brands. They own stuff like Vizzy, some smaller ones. You can look at all their brands on their website. They've experimented, they've tested, they've tried to grow some, kind of in an experimental manner, but none of them have caught fire. And I'll show you a chart here from the KPIs at FinChat, Ryan, where it looks, you can totally see this decrease, and then the Bud Light help on their Molson Coors America's volume. So if we're looking at this, I'll describe it for the listeners. You have basically their volume of beverages that they're selling to distributors. From 2018, they had 72.3 million hectoliters, and then that declined down for the year ending in December 2022 to 60 million. So a steady decline. But from 2022 to the last 12 months, it's gone from 60 million back up to 63.5. So it has stabilized, but you can totally see that seltzer impact from 2018 to 2022.
Yeah, there's a lot of, it just feels like there's a lot of moving parts in the alcohol industry overall, because you've got, on the one hand, the people that are like dedicated beer drinkers that were maybe constantly choosing Bud Light, have a number of them have shifted following this incident. And then on the other side, there's people that have, maybe not every time, but slowly shifted a little bit towards seltzers. There have been a lot of, not really as much in the beer industry. I mean, there's certainly been the craft brewers popping up more and more, but there's been with seltzers, it's a lot of like influencer driven brands as well. That you're seeing that almost like with the hard alcohol industry. We looked at Diageo a couple of months ago, and there's a lot of celebrities that would launch tequila brands, something like that, and it's not necessarily displacing the huge brands. Like, I'm thinking about with the seltzer industry, I know there's a brand called Happy Dad that is specific to a certain influencer group. That's not going to kill Coors, but if you get these constant pop-ups of smaller brands that have cult-like followings, it's going to eat away at the margins, and you're going to see probably a little bit of a gradual decline in beer consumption. So that's why I kind of say it's just, there's a lot of moving parts where it's hard to parse through and get a sense of overall beer consumption. So I guess I'll ask you this right now. 5 years from today, do you think there will be more or less beer consumption in the United States?
Overall, I think there will be...
Let's go per capita.
Per capita? Yeah, okay. So maybe we get some depending on how population growth works out. I think it will be slightly less. Gun to my head. Not a huge hard take, because we've seen seltzers, in the near term, they have hit a near-term peak, I guess, and stagnated a little bit. So maybe we're seeing a reversal. I mean, who would have predicted the switch from beer to spirits? I mean, it seems kind of unpredictable until it starts. And maybe the spirits growth, it will also stagnate. Who knows? But the thing I would say, though, is with that decline, I would be confident that Coors Light, which we'll talk about with this distribution stuff, will gain share and maintain that share. And they also have pricing power that they can go along with inflation. There's some other things here, Ryan. You talked about the competition with seltzers. Remember, there's canned cocktails. There is the headwind of spirits slowly gaining share over the last couple of decades versus beer in the United States. But on top of that, younger people are just drinking less than older people in general. So according to the 2023 Investor Day that Molson Coors had, Gen Z is drinking 20% less than millennials at the same age. And there are also fears, which is causing the stock to go down this year. I believe that's the narrative out there, which I've seen a lot of people discuss, that the weight loss drug usage will lead to a decline in drinking. There's been some connections, some studies done around that as well. So that's a narrative that is formed, that beer volumes will continue to decline in the United States and could get worse over the coming years. And I think that's why the stock is trading at its cheapest multiple in years, which is nice because it's easy to figure out why the stock is down. So you have to kind of ask yourself if you agree or disagree with the question. So that's a good thing about a simple company like this.
Yeah, the other one, which we haven't even discussed, and I'd be curious if there's really any data supporting it, is with a lot of the states legalizing cannabis, I wonder if that's led at all to declining consumption of beer among younger cohorts. Yeah,
that could be a good case. I did throw up some questions on Twitter/X, and people did talk about hemp beverages, so almost cannabis infused beverages. But I think that's got to be a little bit different. I think the overlap, if people are using cannabis a bit more because it's legal, I don't know if that's what's impacting alcohol sales. I think it would just be the health focused stuff and alcohol in general, the switch to spirits, and then the switch to hard seltzers. I have a question for you, Ryan. Of these, I listed off some of these trends that mostly, except for that Bud Light stuff and the execution within the beer category, are headwinds. Which of these trends scares you the most?
Yeah, it's tough. I don't the premiumization of the alcohol industry, the shift towards uh spirits. I don't know if that I think that's something that'll kind of maybe ebb and flow, honestly. I don't know if that's like the most concerning. I'd probably say just the overall number of drinkers in younger cohorts going down. If I'm a shareholder, that would be the biggest concerning, the most concerning one, because it's like the tobacco industry, except you just don't have the same level of pricing power. So
Yeah.
you're not able to offset a lot of those volume declines. I think the thing that concerns me the most is that I just really have no idea where beer consumption would head. Now, that's the industry overall, but let's talk about Molson Coors' position within the industry. I guess real quick, is there a trend that we've spoke about that concerns you the most?
Yeah, I agree with you. That would be the one that concerns me. Basically, that Gen Z stat that we see touted out there, plus the weight loss drug stuff, because as you mentioned, it creates so much uncertainty, which I think is scaring a lot of people. And I don't know if anyone can have any hard take. There's so many factors at play here. For example, I think light beer consumption is almost similar to tobacco, where it might be a bit counter-cyclical. So since the economy has done so well over the last 10 years, excluding COVID, maybe that had an impact there, right? Where people will say, hey, look, I'll have some beers, or you know how it is, right? When those type of things are counter-cyclical. But yeah, definitely does scare me. Let's talk about alcohol distribution in the United States and how Molson Coors is going to use it to its advantage. Ryan, do you have anything else to add before I go to that?
No, let's jump to it. Talk about Molson Coors' position in the beer industry overall and how distribution works and why it might help them.
Yeah, so you might be wondering as a listener, why at the grocery store or the convenience store or the bar or the restaurant, why is it the same brands every time? And it comes back to the fact that we have a unique distribution system in the United States for alcohol producers. So alcohol producers are required to go through independent distributors to sell to retail outlets in the country. One might argue this drives up prices because, you have more regulations and you're forcing another business to become a middleman to be involved here. But the point when they made this, which I think was after Prohibition or maybe before it, was that a brewery couldn't go exclusive with a retail outlet and force people to buy only their drink brands. So example, a Coors could say, look, we have this restaurant, you're going exclusive. If you go to this restaurant, you can only drink Coors. So Molson Coors, for example, here, even today, is mostly required to sell through distributors. Then the distributors sell to the retail outlets, which are mainly grocery stores, convenience stores, and bars. So if a retail outlet buys beer from a distributor and then it does not sell, that grocery store is going to be upset. For example, like a Kroger. The distributor is then going to be upset with the beer brand. This is exactly what happened with Bud Light last year. They hit an oversupply after the advertising incident, and it put huge stress on the distributors. Now distributors have a sour relationship with that brand. Molson Coors has taken advantage of this. Over the last 12 months, the beer distributors have greatly increased the volume coming from Coors Light and Miller Lite, which I think is likely to remain indefinitely. For the simple reason because a grocer on average is not going to get rid of a beer brand if it is selling. So as long as Coors Light and Miller's Light, Molson Coors in general, don't make a mistake, they're going to keep that shelf space and that distribution and that supply coming into the grocery stores, the bars, the restaurants, the convenience stores. And that's the most important thing because you want it to get right on the shelf, right in front of the customer. It's not going to have as much e-commerce disruption because of the ID stuff. What do you think of that, right? I think it honestly is a competitive advantage because it makes it so hard. And we have a chart here in the newsletter of U.S. craft brewery count has gone from essentially, what do we have it here? Almost at 10x in a decade, maybe even just a 5x there. And despite that, that's not really where the volume impact has happened for Coors Light or for Molson Coors in general. It was from that seltzer and spirit stuff.
Yeah, and the other part is I would assume that also presents some scale economies where
100%.
if you're Molson Coors and you're giving them truck trucks full of Miller Lite and Coors Light, and you have a number of brands where it becomes more efficient for the distributors, where you're packing the trucks full of different brands, you're probably getting some cost savings there relative to kind of a niche, more craft brewer. So definitely, I do think the distribution is an advantage for them. My concern around assuming any sort of market share gains is, like, I think the market share that Bud Light lost is probably here to stay. That's not a comment on the incident. That's a comment on distributors. They seem to be happy with the replacements here, and they're going to keep stocking those that are selling. The grocery stores are going to keep stocking those that are selling. But my guess is that after 2 years, they have some idea of how much Bud Light is selling today. So I don't think there's I wouldn't assume that Coors Light or Miller Lite is going to see significant market share gains from here.
Yeah, it's not going to be the same. Yeah, so the thing about the distributor stuff and how it gets things stuck is that it can help you maintain your position versus this onslaught of microbreweries and small local ones that happened over the last 15 to 20 years. But it makes it really tough to make inroads. It's going to be an incremental thing. Now, the good thing, though, is that Molson Coors is the most liked producer from the distributors currently. So in 2024, I think, they did a survey, 93% of distributors. I don't know what the actual question they asked was or how scientific the survey was, but they did a survey and they said 93% of confidence in plans to build momentum with Molson Coors in 2024. So we'll see what happens. But again, it's not going to be the same jump that they saw from 2023 to now.
I have some questions around that phrasing. 93% confidence in plans to build momentum.
Yeah.
Does that mean they're going to add more volume through those distributors? Who knows?
But look, you would much rather be Molson Coors in the United States than AB InBev right now.
100%.
That's the fact of the matter.
Yeah, 100%. FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. And beyond that, they have company-specific segment and KPI data on more than 1,500 stocks. So to give some examples here, you want to see Netflix's average revenue per member over the last 10 years? They've got it. You like to track YouTube's advertising revenue? They've got that too. If you want to see Celsius's revenue that comes from Costco, how much of their revenue comes from Costco, they also have that. So the breadth of FinChat segment and KPI data truly is one of a kind. I use FinChat every day to track and manage all my investments. I also use it to discover new investments. And if you want to get 15% off any paid plan, go to finchat.io/chitchat. That's finchat.io/chitchat to get 15% off any paid plan. The link will also be in our show notes. Earlier in the show, you heard us talk about the investing platform, public.com. That's where you can trade options with no commissions or per contract fees, and you get a rebate of up to 18 cents per contract. NerdWallet recently gave Public 5 out of 5 stars for options trading. If you want to see why, go to public.com and start getting a rebate of up to 18 cents per contract traded. This is paid for by Public Investing. Options are not suitable for all investors and carry significant risk. Full disclosures are in the podcast description. U.S. members only. Let's go a little bit through the management. Who runs the company today, and what is their growth strategy if they have one?
Yeah, the interesting thing about Molson Coors is that if you look at some of the trends that have happened, for example, the switch from spirits to beer, the growth of hard seltzers, the Bud Light incidents, they had no control over that, which is kind of concerning, right? Like, that doesn't make it that great of a business. They don't control their own destiny in a way. So I'd say it's not the highest quality thing. But at this end of the day, Coca-Cola doesn't either when they lose share to energy drinks. Now, let's go through the management. CEO is Gavin Hattersley. He's been there since 2019. He's an accounting and finance guy. He's actually grown through the business and the multiple subsidiaries that they've now consolidated into Molson Coors to become the CEO in 2019. This was after the merger again. So he didn't maybe he was a part of it, but he wasn't in charge when he made this merger at a maybe inopportune time right before seltzers take over. And then he joined right before COVID threw everything topsy-turvy. So it's very hard to judge this management team. And like I talked about, how much did they actually, they didn't cause the Bud Light to make that mistake. It's almost like you have to just keep hitting singles and saying, we're going to keep this advertising. We're going to go to the same playbook of running the same Coors Light type advertising and Miller Light type advertising every year and hopefully maintain our position. There's not much they can do.
If you
What?
if you risk growing outside of your standard cohort, if you risk going for a different marketing message, you end up in a Bud Light type situation almost.
Yeah. Luckily, Bud Light was the one that made that mistake, and I think no one's going to make that mistake for a while here. The company strategy is fine. It's fine from what I hear them talk about. They run the consistent marketing playbook. They try to increase distribution. In the last few years, Coors Light and Miller Lite have started to gain share, which I think if you say COVID was kind of a weird time, maybe that's a good sign about Hattersley and what he's doing here. They're testing a bunch of non-alcohol, non-beer stuff. They want to continue to premiumize the volume. So, for example, getting someone to switch from an Ice House to a Coors Light. Obviously, Coors Light isn't a, super premium product, but they want to move people up to stuff like Blue Moon and stuff like that. They're doing well in the UK with Carling, and they have this other upstart called Madri, Madri. Don't know how to pronounce it. That market's fine, but again, it generates no profits for them. So I don't know how much it matters. But the one thing I did like is the finance team is performing quite well, at least this new one. So after taking on a huge chunk of debt from the merger in 2015-2016, their long-term debt went up to $11 billion for a business that generates $1.4 billion in free cash flow. So a huge debt load to try to absorb. Today, they've decreased that to $5 billion to a much more manageable position, which I like. Debt is not all due soon. They have one that I think is even due in 2062, which they took advantage of the ZERP era. And they just refinanced some Euro bonds of 800 million euros at a 3.8% interest rate due in 2032. As I said in the write-up here, bless the European Central Bank for letting people do that. And they've recently launched a buyback to take advantage of this potentially cheap stock, $2 billion that they plan to implement over the next 5 years. For reference, they have a market cap of about $10 billion today. So look, that could be a big chunk. They could take down 20% of the market cap, and shares outstanding have started to decline at a 2.5% rate annually since June 2023. That should continue and increase with the stock at a cheaper level today. And then the dividend per share should start to grow again and currently yields over 3%. So I like that. What do you think of their capital return strategy with the dividend and the buyback here, Ryan? And the debt?
I like it. $2 billion is nothing to shy away at. Now, typically, sometimes you'll see these authorizations and it doesn't really mean much. But with them actually buying back some stock and doing so at what would come out to 2.5% of their shares every year, you pair that with the healthy dividend that has consistently grown, I assume, you've got good returns.
Well, it actually hasn't because of the merger, but it should. They have the firepower to grow it now.
Oh, okay. So 3% dividend yield, 2.5% on the buybacks. We call that a 5.5% shareholder yield. I do like that. Here's my question for you. It seems like the Miller Lite acquisition actually worked out quite well. They went from generating $400 million in operating income to $1.7 billion. And part of that is maybe some growth of the brand, but also maybe some cost synergies that get included when you have multiple brands and it becomes those, like I said, economies of scale with the distributors. Would you be concerned if you saw them do another one?
Yes, because I'd be worried about what price they pay. I think the only thing that is troubling about that is they bought it at just the wrong time, where they could have definitely got it at a cheaper rate. Now, the thing about this acquisition was that they already owned a minority stake in this company, so now they fully consolidated. It's very confusing. I don't honestly know all the details of it, and I don't think anyone needs to today know the full details because now it's fully consolidated under this company. But yes, it was right near the peak right when hard seltzers were about to just take off crazily. And they probably could have gotten at a cheaper multiple, although it is interesting because they already owned a minority stake. So how much of a benefit would that be? It kind of reminds me of, in a less extreme way, when Altria bought Juul, when Juul was about to peak. What are you looking at here, Ryan, for the shared screen?
Just pulling up some of the dividend yield, buyback yield, and actually there's shareholder yield as well. So if you include the debt pay down, the dividend, and the share buybacks, it comes out to about just under a 10% shareholder yield.
Yeah, and I think that makes sense. Now they should be able, now that they've hit their target. I think they use an adjusted debt to adjusted EBITDA or debt to EBITDA thing of about 2.5 times. They're not going to really pay down the debt anymore. The interest expense is much lower today. They are going to focus solely on putting that to dividends and buybacks. So I think we should get, prospectively, we could get 10% plus dividends plus buybacks going forward, which is great. I think that's a huge highlight for the stock, especially with it trading at such a cheap multiple now. Now, last thing is the proxy. Executive compensation here is a mess. There are about 10 different criteria for various bonuses talking about, quote, underlying free cash flow, which always annoys me. They have like adjusted underlying operating income, bunch of nonsense. 10% of the bonuses are based on the people and planet scorecard, which is great. Good. That's what I want as the shareholder of Coors Light, you know? And for example here,
Who
let me
else
see
is
if you
going to
can...
do it? You know?
Yeah,
These are the people we need solving the world's biggest problems.
exactly. Just recycle your aluminum cans and glass bottles, and I think we'll be fine. The stock rewards are based on, now try to figure this one out, Ryan. Quote, relatives total shareholder return over the 3-year performance period in the 90th percentile relative to the companies in the S&P 500 Consumer Staples Index at the end of the performance period, which achieved maximum level of performance. So apparently, Ryan, they were 90th percentile on a 3-year relative total shareholder return versus the S&P 500 Consumer Staples Index. So relative return, not great either. It's definitely a downside. But if we look at the actions on capital returns, it's good. So I don't like, it's just kind of nonsense for the executive compensation, but I think they understand, given that this guy that runs it now is an accountant guy. He knows numbers aren't going to be the concern here. He knows how to value a stock and to increase the buyback, all that good stuff.
Yeah, I read that line that you quoted there from the proxy statement 3 times and really did not grasp it entirely. Relative total there really isn't a perfect formula for CEOs that aren't founders necessarily. Like there's going to be some way that you could massage the numbers to hit the right incentives if you're someone who has certain hurdle rates. I do like total shareholder return over a certain time period because it kind of smooths it out and it guarantees that the executives will be there for some time.
But not
Yes.
relative. Not relative. Relative's useless.
I know. Relative when the whole industry is declining. When you're benchmarking yourself against Bud Light, who just had a rough year. Yeah. I don't know. Don't love that. But like you said, their actions speak louder than words here, and they're doing the right thing capital allocation wise. So sometimes I kind of just throw the proxy out the window. Yeah,
I agree. I think the actions there are more important. Yes, it would be nice if the executive compensation was great, that box doesn't get checked, but it doesn't, it's not going to kill it here. I'd say overall, looking at this management team, I like them. I don't love them. They talk reasonably. They act reasonably. I'm not going to be, I'm not going to stay away from the stock because I believe they're a Jack Dorsey type one at block or where I have no confidence in them. It's not that bad. It's not something where if the other 2 boxes that I care about, which are sector, growth, valuation, all that good stuff, confidence in the moat, if those boxes are checked, this isn't going to keep me away.
Yeah, I agree. Let's go through the financials and maybe the balance sheet as well. Do some of the back of the napkin math here. What's it going to take to generate a good return for investors?
Yeah, so as I mentioned, Molson Coors trades at a market cap of $10.3 billion. It has generated over $1 billion in operating earnings every year since the merger, which would be 2017, I believe. And over the last 12 months, it's been $1.76 billion. So you look at that and you go, 10.3 billion, 1.76 billion operating earnings. Hey, that's nice. That's pretty dang cheap. Interest expense from the debt is coming down. It's only $200 million or so on a net basis each year now. So definitely manageable, not really a concern. Free cash flow has been over $1 billion every year since 2017, except for 2022, and was $1.4 billion over the last 12 months. It now has an earnings yield well above 10% if earnings remain stable, and they can probably reduce shares outstanding by 5% or more each year at the current multiple. Now, the question is whether these earnings will be stable. So if volumes remain stable, which they have over the last 2 years, but as we looked at that important chart from 2018 to 2022, they were declining by a good chunk every year. The company can grow the top line by probably 3% to 5% a year through price increases and that mix to more premium brands. The big question is, Ryan, and any other questions you have on financials, what do the volumes look like over the next decade? That's the huge uncertainty we've talked about already.
Yeah, I would think that over the next coming years, you're going to see probably, my guess, if I were a betting man today, volumes decline for Molson Coors. Now, over the last 2 years, you've seen probably that trickle of Bud Light customers coming over. But the 5-year trends don't look quite as favorable, and I would think that the Bud Light customers that they've lost, probably it doesn't get much worse. So, I don't know. I would be wary about betting on too much volume growth. What does pricing look like?
Sorry?
What does pricing power look like?
Actually, little spoiler for the listeners. Ryan said he was going to ask this question, so I do have the chart loaded up right here on FinChat. We have America's revenue since December 2018, so that's the Americas segment. And then I have America's volume since 2018. America's revenue has grown at 1.9%, while volumes have declined by 2.5% a year. So growing at 1.9% per year, while volumes have declined at 2.5% per year. But again, volumes did start growing last quarter. So I'd say pricing power has been decent, especially with inflation, though, right? So I think they can keep up with inflation, but unlike tobacco or maybe soft drinks, they can't outpace it as easily.
Brett, do me a favor and okay, never mind. Share that screen again and hit separate y-axes because it was too hard to see. One of the numbers was too small because the volume was calculated in hectoliters.
Yeah, and how do you do that? Separate X?
Yep. If you just and yeah, there we go. So we have a better sense of the size here. Yeah, so total volumes have been declining at about 2.5% a year, despite the recent jump over the last 2 years. Yeah, I guess it's kind of a crapshoot on the volumes growth. That's probably my biggest hang up here. But total revenue growth, solid, kind of gives you a sense of the pricing power there. Let's talk about the risks, as long as I think we've covered most of the financials there.
Yeah, I think so. Yeah, I'd say one note is that they do experiment a lot, and they haven't over the last 5 years had any sort of success on a big growth of like turning something into a Truly or a White Claw, or I guess I don't know any other beer brands that have really broken through. Maybe, like a Modelo, obviously it's a huge one. And I would say I would be confident volumes are going to go down or not grow, excluding any new brand success, because they are experimenting with a lot every year for these new ones. And given the distribution, if something catches fire, obviously they could increase volumes by a ton.
Okay, what do you see as the major risks for this business?
So we've talked about these a little bit, and there are 2 risks on this. I think there are 2 risks that people talk about. First, people are concerned about the one-time benefit from Bud Light that will revert in the coming years. I've seen a lot of people when I talk about, hey, why is the stock so cheap? And there's a lot of people writing up, hey, the Bud Light's going to regain its volume. But again, when we talked about with the distribution shift, I don't think this is a concern, as we discussed above. I honestly think over the next year, volumes could still see a little benefit if the distributors restock and do their new shelving, which doesn't happen right away. But the second thing people are worried about the broader beer and alcohol market. Gen Z and younger people drinking less. People are drinking more spirits compared to beer, and the Ozempic and weight loss drug narrative. I think the second one is a real concern. I'm not, we talked about this entire episode. The big hang up here is I'm not confident in the trajectory of the beer volumes over the next decade. It could be flat in the US compared to today. It could be down 20% or it could be up 20%. I have no clue. This presents perhaps an opportunity for someone that has a sharper mind with this industry, but it's also a ton of uncertainty.
Okay, I think we've discussed the volumes question here kind of enough today. So let's get to the, I guess, final question for you. Are you buying the stock today? Are you buying Molson Coors?
Okay. Let me start out with saying I think Molson Coors looks cheap. It's at a 10% earnings yield. Investors can make a 10% annual return if the business stays the same. I think we could say a 15% annualized return with slight sales growth and multiple expansion, which I wouldn't count out if sales growth remains, positive for the next few years. It's trading at something that grows its sales at that level is not going to trade at less than 10 times earnings forever. And I think that's a plausible scenario. And I expect the stock's total return to be positive X inflation over the next 5 and 10 years. I would bet on it versus the S&P 500. Although some people care about that. I try not to, care about that. Relative return, as we talked about, doesn't actually matter at the end of the day. But if I had to guess, if I had to say, are you going to choose the S&P 500 index fund, or are you going to choose Molson Coors over the next 5 years? I'd definitely choose Molson Coors. Ryan, would you? What would you choose if you had to pick one?
Between those two, I'd probably take Molson Coors.
But we're also at an extreme multiple right now for the index.
Yeah. I think there's, just when I look at my own portfolio, there's probably other companies I would buy first. There's other stocks that I maybe like better. And especially when I think about like sin stocks as a category, I look at Molson Coors and I think, why would I own Molson Coors instead of Philip Morris? It seems to me like Philip Morris has a better chance of growing volumes in the aggregate over the next 5 years, where you don't have as much of a concern there on like the underlying trend. So
yep. Yeah, you jumped the gun on my segment here. I was going to mention that as well. I guess I should answer the question. I'm not going to be buying it because I am not as confident in the competitive advantage and the sector for any sort of predictive value on the durability of earnings over the next, you want to hold a stock for a long, long time period. Now, for example, you mentioned Philip Morris International. It's in my portfolio. It's in Ryan's portfolio. It trades at a slightly higher earnings multiple than Molson Coors. Sure, that's a factor. But on the other hand, I am confident it has better pricing power than beer. Historically, it has a better competitive moat with a historically less competitive industry. And it operates in a stable industry from a volume perspective when you do nicotine and plus tobacco. So the entire nicotine category, which they have more exposure to, is growing. Now, if I looked at or maybe it's not growing, but it's stable over worldwide. Now, maybe this would be a better investment if it had more spirits exposure. It's a tiny percent of their portfolio. So if this was someone like, people have talked about Brown-Forman, that we should look at them. Maybe that'll be the next one I look at here. Diageo, I just really didn't like the management team. If that had more exposure, maybe the stock's cheap enough here. But I think the reason it's under 10 times earnings is because of the beer, because people are so worried about that. And for me, that outweighs the positives for Molson Coors. What price? I know trailing earnings multiple is not the end of the world, is not the end all be all. But Ryan, what EV to EBIT are you buying Molson Coors?
Well, I think right now, I think you can get a 10% annual return with the Coors. You've got good shareholder returns here between the dividend and the buyback, and then maybe some small level of revenue growth as well. And they're going to earn probably, they have more capacity to return cash to shareholders than they're currently doing. So I would suspect that, yeah, you're looking at potentially a 10% IRR. I think 15% is a bit of a stretch. It's hard to know what the floor is going to be on volume growth because volume could decline a lot quicker. Maybe Bud Light could regain some of its market share. Maybe the industry as a whole is going to see volume declines. But the ceiling, I don't think it's going to grow faster than like 3 or 4% volumes annually when you look out over 5 years. So I think 15% seems like maybe a bit of a stretch here for an IRR or expected returns.
Don't forget multiple expansion, Ryan. That could, that's a factor, obviously.
Yeah, I'm not sure what exactly the multiple would be, but I would say when I feel comfortable with the same growth assumptions and I can get a 15% return, that's kind of what at least when I'm just looking at my other investments, that's kind of what I shoot for. Does not work out every time. It just doesn't feel like you're getting that here.
Yeah, I think maybe 7 times EV to EBIT would be that number. It's not a precise science. It's a probabilities of outcome here, but it seems like that would be more reasonable if you're looking for that 15% return. Now, if 10%, that's what you shoot for, maybe that's even better. You want something safer, this could be the place to be. And hard to know. I think it's going to generate solid returns. I would be surprised if the total return is negative over the next 5 years.
I agree. Now, I do think people are probably listening to this and thinking, okay, 9.7 times versus 7 times EV to EBIT. Like, why are we being so nitpicky over the valuation? If it were a company that was growing quickly and I thought there were a lot of tailwinds behind it, I wouldn't be as nitpicky over like 15 times earnings versus 18 times earnings because you have that growth to kind of support it. And over the long run, you have some sense of security that it's going to keep growing. When it's a business where you could be seeing overall volume declines, I think you have to be a little more nitpicky over the valuation.
Yep. And when the buyback is such a big factor, or it's only been implemented for a small time period, but could be a huge factor going forward.
Yeah. And the lower the multiple, I guess, the higher probability of multiple expansion.
Exactly. And the buyback works even better. All right. Closing thoughts, Ryan. Anything on Molson Coors you want the listeners to take away?
No, I thought it was really interesting on the distribution point. My thinking here is that you've got a lot of alcohol businesses trading at record low multiples. As a whole, if you took that whole basket, I think it probably outperforms the index because it seems like people are maybe overestimating the decline in alcohol consumption and what it'll be for the next decade. But Molson Coors, I don't know, maybe I got to look at some of the other alcohol companies before I pull the trigger on any of them.
Yeah, and I was going to say what should be the next stock I research, Ryan. Do you think Brown-Forman? I think they own Jack Daniels. A little more spirits exposure. That could be interesting. And it looks like, according to FinChat here, PE or EV to EBIT, EBITDA is below 20 now. So,
I don't know. Maybe something a little sexier. Maybe I generally like fishing in industries where I have a good level of confidence that there will be growth.
True.
I know the valuations aren't as exciting, but it's nice to have that little bit of a consistent tailwind. You look at like Visa or MasterCard, digital payments, it's something where there's some level of growth that kind of propels a lot of the businesses. It just kind of excites me a little more. So I'm thinking maybe we stray away from the alcohol category for your next one.
All right. I will say Brown-Forman is in its biggest drawdown ever. So, but probably deserved given the concerns people have over the category at the moment. Anything outside of this one that comes to mind that you want me to research for the next month?
I don't have a specific one in mind. The other thing I would just say is I was looking at the 52-week lows list, and like half of them, it felt like were alcohol companies. So I think the 52-week lows is a nice place to look. There's probably maybe some alcohol companies in there. Is there anything that's piqued your interest that is not an alcohol stock over the last month
not
or so?
alcohol? Not really. Had a couple that I've bought this year. What's funny is the one that we covered that I did research that I thought I didn't have confidence in management. It ended up going up 100%, which was Hims and Hers. But nothing that comes to mind. I guess. Yeah, it's hard because we try to do one that we can listen to. I don't know, or excuse me, not that we can listen to, that listeners want to hear. That's not some super niche micro cap out there, but we'll figure it out. I'll find one to research. That'll be fun.
Okay, well, I will tease listeners with this. My stock for next week is a 430 bagger over its history and has been one of the most consistent companies with a return on invested capital above 20%. They have been quite the compounder. So I won't say the company name, but I'll leave it at that.
Yeah, look out for that next week and some more fun interviews, investment, funds, manager research reports, kind of as we've been doing on these past episodes, some more stock research stuff, some fun portfolio updates. We'll have that all consistently coming every Wednesday. For any housekeeping items, make sure again to subscribe to the newsletter, especially for these stock research episodes. There's going to be a ton of good stuff, probably about 10 pages of some notes and charts that you can help understand Molson Coors better. Let's hit the disclosure. We are not financial advisors. Anything we say on the show is not formal advice or recommendation. Ryan, I, or any podcast guest may hold securities discussed in this podcast, may hold them in the past, and may buy, sell, or hold them in the future. Thank you, everyone, again for tuning in and learning about Molson Coors stock with us. We'll see you next time.